I think the point that I would like to, or maybe just to introduce myself, I'm the Principal Executive Officer of the Anglo Platinum Retirement Funds. So about 64,000 members, mainly in the mining sector, and about 12.5 billion rand of assets under management. One of the larger funds in South Africa, but minute compared to my colleague next door to me here. And I think that's the point I would like to raise is that there is a lot of money in the various pension funds in South Africa. However, we are generally, in terms of the investable amount in such projects is quite small. And as a result, we need vehicles to be able to invest in. Typically, many of our funds, pension funds, retirement funds in South Africa are defined contribution funds where assets must match liabilities. Also, many of our funds follow a fixed asset allocation type model, which requires any cash flow that comes from monthly contributions to be allocated according to the strategy being set on that fixed asset allocation basis. There are different models, but the funds that I particularly follow is fixed asset allocation, so we're unlikely to deviate. When you have such a particular model, a typical South African pension fund is not going to invest in an infrastructure, one single infrastructure project, typically. That's not going to happen. One of the reasons why is our trustees and the officials like myself in South African pension fund, we do not have the resources or the skill or the capacity to do the due diligence required for such projects. We require, and many of us do require, external resources to do it on our behalf. We need to appoint asset managers, project managers to do the due diligence on our behalf. Now, a number of funds, and we in particular have been involved in the infrastructure bond fund for some 15 years. And any skeptics think that the infrastructure bond funds do not return. We have had excellent returns over those years. We involved in the Future Growth Infrastructure Bond Fund, and they have delivered in excess of 1.5% to 2% above the All Bond Index consistently over those years. But why do we use a manager like that? Well, because they have the resources to oversee all the due diligence and the monitoring that's required after you've done the investment on our behalf. That's obviously local infrastructure, and what we need as a South African pension fund is to mirror that type of model into Africa, where we have a manager who can do that due diligence on our behalf, to monitor on our behalf, and to report on our behalf. We also require a vehicle that can provide daily pricing, because our assets need to match our liabilities on a daily basis as required by our law. We need to have daily pricing mechanisms, and obviously to deal with the constant cash flow on a regular basis. So those are some of the challenges I would put to you. Come to us with a product or a vehicle that's affordable. Our National Treasury has been very vociferous over the last number of months and years about cost of products, and we would urge you to look carefully at the pricing, because otherwise it's going to become a problem for us to be able to justify the high cost of some of these products. So we would really urge you to come with workable projects, almost a fund-to-fund type of approach that can have regular cash flow on a monthly basis in terms of new contributions, and that we are able to do. I think the one thing that also, just in terms of our regulator, is make sure you have your 13B license in order to operate. Otherwise, we'll be in contravention of our law here in South Africa. But I think the issue is that there is money. We want to diversify our assets. We want to make sure that we have a diversity of different vehicles to be able to ensure decent returns to our members. And especially with our Regulation 28 that was amended about 18 months ago, we allow 25% offshore with a further 5% into Africa. So potentially we could invest 30% into Africa. There's nothing stopping us doing it, but give us the vehicles in which to do that 30% investment into Africa. And a model that I would advocate is a model like the Future Growth Investment Infrastructure Bond Fund, which is a model that many of our funds can work with, and I would try and replicate that sort of a model for us to be able to talk to you. I think that's
the 30% you have. What are the mechanisms you're using to mobilise those funds for cross-border activity? Initiatives you take?
Okay, typically a South African retirement fund would, especially on its 25% portion of the 30%, would typically use a European-based and predominantly a UK-based type of asset manager to invest, and that generally would have a European and American and a bit of a Far East type of exposure. Very, very little to Africa, in typically that 25%. That 5% additional Africa exposure, and I said that could be the full 30%. There are very, very few South African funds that have done so, mainly because of the issues that John has raised. The equity markets are generally quite small. There are very few products for us to be able to invest in, and generally we would look at the product because it's to invest directly on one of the African stock exchanges for a fund like ours is very, just from a practical point of view, very, very difficult. Many of our funds are invested through policies of insurance. It's only the larger funds that are segregated, and so also generally it's a lack of vehicles for us to be able to use. And if we can find more vehicles to use, there would be an appetite because we have to diversify our assets. That's what our job is about, is to spread the risk and to make sure that we're not overexposed, to certain risks. But I think there are limited opportunities for us at the best of times.
Doing business in Africa, you can't afford to be without Africa Investor.